In part one of our discussion with Dr. Robert Hartwig from the Insurance Information Institute, he provided insights into the impact of the economy on the insurance industry, cyber risk, and other opportunities for growth in the industry. Here, Bob provides his outlook on the P&C sector, the personal lines market, agents and brokers, and reinsurance. Here are the highlights.
For the commercial P&C insurance industry today, you've got two major influences. You've really got the economy. Commercial insurers have always been very much tied to the overall economy, whether we're thinking about workers' compensation, the base for which is payrolls, which is tied, of course, to new job creation or destruction, as well as wage and salary growth and pay raises under that. We're talking about investment activity, decisions by businesses whether to make investments in infrastructure that ultimately has to be insured pretty much forever, and these sorts of things. We're also talking about government fiscal policy, and this is one of these brighter areas. We're starting to see governments, whether it's particularly state and local governments, have now recovered from the economic downturn, now have some money in their coffers and are thinking about putting and spending on some long-delayed infrastructure projects. That is a very potent driver of commercial insurance exposures out there today. So we can also look at the regulatory environment. In the tort environment is always an issue, plays a little bit lesser of a role than it does today. We have fewer so-called judicial hellholes in the United States than we perhaps did a decade ago, and we owe that to tort reforms, although we have to guard to make sure that those reforms do remain in place. And of course, we have the rate environment. So to what degree does pricing remain disciplined and rational within the industry so that pricing reflects not only the underlying loss cost trends, the underlying frequency and severity trends, but the reality of low interest rates. Again, all else equal, pricing does need to be higher in circumstances in which interest rates are lower. That's just the basic arithmetic of the insurance industry. Well, in personal lines, they're good news as well. We've seen new car sales and light truck sales now recover to where they were prior to the recession. We're seeing a slow recovery in home building. Low interest rates do help that particular sector, and new home building, it's not so much an issue for new homes being put on the books that are going to be insured by home insurers. That's a big part of it. It's also, of course, a lot of construction activity that creates commercial lines exposure. But one challenge for personal lines insurers on the home side, if we look at home construction today, a lot of it is in multifamily dwellings. And again, that's that preference by millennials who are coming out of their parents' basements and deciding they want to live in apartments or condos, they want to live in urban areas. And what they very often don't realize is that they actually do need insurance to protect their valuables, that their landlord has no responsibility if that property is damaged or destroyed. The landlord has no responsibility for the thousands of dollars of electronic equipment that they have in there, their laptop, you name it, but that can be easily insured, usually for a couple $100s a year with little more than a phone call. And these individuals also would benefit from this, and the insurers would benefit as well, because you can think about renters as kind of a gateway product. Renters insurance is a gateway product to what will eventually be, hopefully, an automobile insurance policy, perhaps life insurance policies down the road, as millennials who have postponed childbearing, who've postponed buying homes relative to their parents' and their grandparents' generation. Eventually, one thing we do know is that the human population is not about to go extinct as a result of the millennials. So we do think that eventually there will be more household formation, and household formation is a potent driver of personal lines demand, both for auto and homeowners insurance. Well, agents and brokers, we've seen employment in these areas actually growing, even as the number of agencies continues to decline through a consolidation process that has been going on through many years. So there are a lot of efficiencies out there in terms that are being realized as agencies do continue to consolidate, and as brokers consolidate among each other or are purchased by consolidators. That could be banks, it could be outside investors, it could be, in fact, a larger broker. So consolidation in the number of agencies and brokers is likely to continue, but I think that there's still opportunity for expansion of the number of jobs in this particular area. And not only that, the number of net jobs will increase, but the number of, I would say, new individuals working in this particular area is going to have to increase substantially, because we're facing a demographic bulge, particularly in the agency ranks, where we're seeing a lot of retirements coming up within the next 5 to 10 years. And I know that the Agents and Brokers Associations have programs in order to try to attract new agents and brokers, young agents and brokers to the system, men and women, right out of college perhaps, who don't come out of a family that has an agency. So it's critical at this point to attract the new blood into the business. Well, on the reinsurance side, we know that prices have been softening for some period of time. That continued to occur in 2015. Their reinsurers were profitable in 2014. There was relatively little catastrophe activity, or it was average at best in most parts of the, not only the United States, but around the world. So they've been profitable, but at the same time, prices have been pushed down through an enormous amount of capital flowing into the system. So that dynamic persists as we move through 2015. So at some point, there will be a dynamic that upsets that apple cart. Now, eventually, something will happen, such as higher interest rates, for example, which might drive some of the excess capital from the industry. What I think is more likely is we will eventually have a return to a year or two with very high catastrophe losses, and where the difference will be is a large number of these insurance-linked securities will be triggered. And then we'll get to see for the first time how investors in these particular types of securities react to large-scale losses. So we'll see whether or not their appetite remains as robust after having tasted some losses as it is today, when the results have been quite good.
For more on the trends affecting the insurance industry, visit the III website or the RIN TV On-Demand Library.